So we are starting our section B. First question, par company. This scenario relates to the following 5 questions. Balance sheet is provided. 8% loan notes are convertible into 8 ordinary shares per loan note in 7 years' time. If not converted, loan note can be redeemable on the same future date at their nominal value of $100. Ordinary share of the par company has a nominal value of $1 per share. The current ex-dividend price per share of the company is 10.9. Share prices are expected to grow by 6% per year for the foreseeable future. Equity beta of the par company is 1.2. The loan notes are secured. Secured means any non-current assets are provided to secure loan note holders. If in case there will be any bankruptcy, that non-current assets will be sold in the market and it will be used to settle the liability of the loan note holders. Loan notes are secured on non-current assets of par company and the bank loan is secured by a floating charge. Okay, means variable interest rate on the current assets of the company. Arrange the following sources of finance per company in order of the risk to the investor with the riskiest first. So the first is always ordinary shares. Why? Because they are the owner of the company and they don't have any non-current asset as the backed up or which is providing them any security that in case of bankruptcy these assets will be saleable to recover your investment. So this will not happen. Second one is redeemable preference shares. They are redeemable. They will be redeemed at a certain date, but currently they are less riskier than ordinary shares, but more riskier than what? More riskier than the uh, bank loan and loan notes. At third number, we have bank loan, and at fourth, we have loan notes because loan notes are secured here, over here. When they are secured, it means any non-current asset is available as a backup. What is the conversion value of 8% loan note? Okay, so to calculate this conversion value, we need annuity tables and present value tables as well. So let me open those tables. Now there are a few workings which will be performed to calculate the conversion value. Then we have other things as well. What is the conversion value of 8% loan note after 7 years? Conversion value is equal to what is the amount of shares which are available. 8 shares are available after 7 years and current share price is 10.9 and 6% growth rate. So 8 into share price 10.9 into 6% growth rate raised to power 7. Once again you can check the information. 8 shares, 7 years, 10.9 share price, 6%. So what is the conversion value? 8 into 10.9 into 1.06 raised to power 7. It is 131.12. 131.12. This is the conversion value. If he asks you to calculate the present value of the conversion value, then you will multiply with the present value factor at interest rate or effective interest rate or cost of debt for given years, 7 years. Assume the conversion value after 7 years is 126. What is the current market value of the loan note? To calculate current or market value, first of all, we need annuity value of interest is equal to, are we provided with the cost of debt redeemable at their par value? Yes, we are provided with the cost of debt, which is called what? Which is called IRR. So we will take annuity factor and present value factor at 9%. Annuity value of interest, $100 is the par value, 8% interest, $8 into annuity factor at 9% for 7 years is 5.033, add present value of redemption, it will be redeemed at 100 into what? Present value factor at 8%, oh sorry, at 9% we need. Present value factor at 9% for 7 years, 0.547. 0.547, and 5.033 is the present annuity factor at 9% for 7 years. So we will do what? 8 into 5.033, it is 40.264 plus 54.70. 54.70. So 94.93. So what is the right answer? Right answer is this one. I think the third one is the right answer. 8 is the interest rate, and this one is the. So question asked current market value. This is basically floor value, not the current market value. For current market value, we will use this apart from annuity value of interest. Annuity value of interest will remain the same, 40.264 plus present value of conversion. This is the floor value, which means minimum income which you can earn or which you will earn. This is called what? Floor value. So it is 126.15 into 0.547. So 126.15 into 0.547, 69 plus 40.264, 109.264. This is market value, and if you are asked to calculate the floor value, then 94.93. Next one is, which of the following statement relating to capital asset pricing model is what? Is correct? CAPM is what? Cost of equity. Where we use what? We use risk-free rate, we use market return, and beta equity to calculate cost of equity. Equity beta of the par company considered only the business risk. Capital asset pricing model considers systematic risk and unsystematic risk. It only uses beta equity. It does not uses the uh, diversifiable risk. Beta equity means market risk, which is borne by all the investors in the market. Equity beta indicates that the company is more risky than the market as a whole. It is basically providing the uh, market risk. The debt beta of the par company is 0. So what is the right answer? The equity beta of the par company considers only what? Considers only business risk And the third one is the equity beta indicates that a company is more risky than the market as a whole. If equity beta is significantly higher than the market, then we can say that yes, it could be. Which two of the following statements are problems in using P ratio method to value of a company? P ratio method basically uses price earning ratio. If it is using price earning ratio of the industry as a whole uh, or of the averages, then it will be considered more reliable than the dividend valuation model, because dividend valuation model uses the information of a specific company and it is using historic dividend with the expectation that dividend will grow by this percentage for an indefinite time period. Maybe in the next year company will be in loss, then the company will not be in the position to increase the dividend. So P ratio is what it is using earnings to calculate the value of the company. Earnings are considered as more reliable and definitely it is more powerful for valuation purposes. In fact, the most highly powerful thing is cash whenever you want to calculate the value. First one is it is the reciprocal of earning yield. It is not the reciprocal of earning yield. Earning yield is what? Earnings divided by price. It means what? It means we are calculating the output or yield of price in terms of percentage, that what did we earn during this accounting period. So it is not the reciprocal of earning yield. It is the opposite to the earnings yield. It combines stock market information and the corporate information. Next one is it is difficult to select a suitable price earning ratio. It is not combining the stock market and corporate information. It is using the market price of the company. It is using the earnings per share of the company. So no information is taken from the stock market. CAPM is using the information of the stock market where it uses stock market return. So second is incorrect. Third is correct. It is difficult to select a suitable P ratio, either to select our own P ratio, either to select proxy company P ratio, either to select industry averages. The ratio is more suited to valuing the shares of a listed company. Yes, because we want to know the value of the listed companies. Either we want to purchase a listed company or we want to sell the listed company. So these are the problems of the P ratio. First one, it is difficult. It is more suited for the valuing of the listed company, more suited in some cases, but maybe in other cases, in a few cases, it is not suitable. And all the companies are not the listed companies. If you want to acquire a company which is not a listed company, you have these ratios as a proxy to calculate the value of the company. So it is the problem, not the easy to use. Next one is anyone, any question? Next one is Zarona company. It's a forex question. Zarona companies whose home currency is the dollar. This is important to understand that its home currency is dollar. Took out a fixed interest peso bank loan. Okay. Several years ago, when peso interest rate were relatively cheap compared to dollar interest rate, Zarona company does not have any income in pesos, so they cannot match their interest income with the interest liability. This is what he wants to convey. Economic difficulties have now increased peso's interest rate. Previously, it was cheaper when you borrowed. Now it is higher, so you would have to pay the high interest rate. But on the other hand, it is expected that its currency is weaker now. While interest rates have remained relatively stable in the dollar, Z company must pay interest on date set by bank. Definitely fixed interest liability it is. A payment of 5 million pesos is due in a 6 months time. The following information is available. When rates are provided in this format, this is called bid rate, this is called offer rate. Bid is also known as buying, it is also known as selling or ask. When you are expected to receive, then always divide by offer rate, selling rate or ask rate, because you will receive lesser. Bank always win. When you are expected to pay, then always divide by bid or buying, because bank always wins. Here we have a position of payment of $5 million. Then interest rates are also provided, borrow deposit for money market purposes. What is the dollar cost of forward market hedging? So 5 million pesos divided by what is the 6 months bid rate? 12.805. So we are making payment. So $5 million divided by 12.805. 390, 472. This is the answer. Indicate whether the following statement apply to interest rate parity theory, purchasing power parity theory, or both. The currency of the country with the higher inflation rate will weaken against the other currency. So he is saying that uh, either it is correct or incorrect. Second one is for both. The theory holds in the long term rather than in the short term. He is saying that this theory will hold in the long term rather than short term. The exchange rate reflects the cost of living in the two countries. Okay. Now, first is currency of the country with the higher inflation rate will weaken against. It is relevant with the purchasing power parity, because purchasing power parity is the one which uses the inflation rates between the two countries to calculate the forward rate. Second one is the theory holds in the long term rather than in the short term. Both of the theories are for the long term, not for the short term. Exchange rate reflects the cost of living in the two countries. Exchange rate is also telling us about the purchasing power parity, or we can say that purchasing power of the population of that particular country. Next one is, what are the appropriate 6 months rate for Zarona company to use if the company hedge the peso payment using the money market hedging? So now he's saying that money market hedging. Money market hedging says what? Money market hedging says now your position is payment position. So deposit what? Deposit present value of the amount now in the foreign bank. Deposit present value of the at the borrowing rate, at the deposit rate in the foreign bank now, and peso payment using the money market hedging. These four different deposit rates are provided. We will definitely prefer to deposit at the higher rate, and then we will do what? In the second step, we will convert this present value at a spot rate in the local currency, and then we will do what? We will make borrowing from the local bank at the local borrowing interest rate. So now we have what? We have four different interest rate. It's a 6 months payment. Highest interest rate is 7.5%. If I divide it by 12 and multiply by 6, 3.75% will be my deposit income if it is possible. And borrowing rate is what? Definitely we want to choose the borrowing rate in parallel. If we are using this as a deposit rate, then in parallel this is the borrowing rate. It is 6 by 12, 2.25. If there is no need to do calculation for the second one, it is clearly uh, seen that it is significantly lower than the borrowing rate. Here deposit rate is higher, so we can calculate the differential. It is same, just like this. So we should use this one for the 6 months, and again we cannot use this one. So this is provided over here. For the 6 months, we will choose deposit rate of 3.75%, and we will choose the borrowing rate, or we would like to choose the borrowing rate of 2.25%. Which two of the following methods are possible ways of Zarona company to hedge its existing foreign currency risk? How to matching receipts and payments? It is not possible here right now. Currency swaps, yes, we can use currency swaps. Leading or lagging, it is not possible here. We can use what? We can use currency futures to do what? To make the uh, hedging. Next one is Zarona company also trades with the companies in Europe which use the euro as their home currency. Euro as their home currency. In 3 months' time, Zarona company will receive $300,000 from a customer. Which of the following is the correct procedure for hedging this receipt using a money market hedge? What is the correct procedure? Trades with the Europe, which uses euro as their home currency. Now it is expected to receive. In case of receipts, you will make borrowing from the foreign bank today in present value terms. Present value terms means you will borrow an amount in which you add interest will be equal to your receivable amount after the 3 months time. So step number one is borrow an appropriate amount in euro now. Second step is convert the euro at a spot rate in the local currency, which is dollar. Third step is place the dollar on deposit, and then what? Use the customer payment to repay the loan. When your customer will pay you, you can repay this loan. So this one, A is the one which is in the correct order. Although the same 4 points are provided in the next three, but they are not provided in the correct order. So this is called what? This is the order of heading.